Good afternoon, everyone. Today was an abnormally nice day of trading. We'll cover both setups that we had here, but first let's go through some P&L numbers, and then we're going to focus on the four major indice markets here. Starting with our cumulative tick trade, this was based off of a heads-up notification by 7 a.m. to expect a likely trending up market. This was the 3:45 SPY call with 1 day's expiration, bought at 2, sold at 3 for a P&L of right around 100 per contract minus commissions. You could have gotten a little bit more than 3 as well. I think it went up to something like 317 or so. But that was still a nice trade for those that are options traders. You did have to deal with a good amount of heat here, so we'll discuss this trade as well. And then for our volatility box here, we had all four futures markets really trigger entries, which again, this is not very normal. It's atypical, but we'll cover the P&L here associated with it. Almost all of these trades were triggered right around the same time outside of the Russell. But starting with the S&P futures first, that was a loser of minus $400. And this was a stop out for literally one tick. And so we'll cover that. Really, that was, I think, more of an emotional management sort of thing, which luckily was bounced back by the gains in the Nasdaq and the Dow. The Nasdaq was the biggest winner for today with positive 1340. The Dow was positive 580, and then the Russell futures trade came towards the final hour of the market close, which was in that 12 to 1 p.m. Pacific hour for positive 225. So all in all, it was a really nice day of trading, and I think it's worth talking about both the loser in the S&P along with this cumulative tick trade and all the other setups that we had as well to see if there's anything we can kind of take away from it, especially once we, I think, start to expect this volatility to increase as we head into election season. Now, starting with the cumulative tick trade first, we have the cumulative tick pro indicator here. This is the version for volatility box members. It's available for free with every volatility membership. But here we have some Boolean conditions that we've coded in, where if all those conditions are true, then by 7 a.m. Pacific, we'll get a likely trending up market, in which we know that, hey, based off of the tick data, we're expecting at least some sort of bullish price action here. This will plot likely trending down if we expect bearish price action. So today we had a trending up bubble. I called this out for all of our futures members in that morning email that I send out. But once we get this trending up, it's really an opportunity at any pullback to try and add into SPY options positions here. So this is where, again, you want to make sure that you have some sort of a strategy that allows you to have a good amount of risk that you can tolerate without it really shaking you out of the trade, right? So for example, if you took futures here, then you have to deal with a good amount of heat here, which I'm not sure that most people can really do, especially once price action starts to go against your way. That's why I've talked about why I think SPY options here, especially the 1 day or 0 days expiration, if we have those available, are a much better alternative, mostly because you have a way to define your risk. Now, at this point, once we had the pullback here, the 345s were the ones that were at the money, the 345 call. If I show you this on the SPY chart instead of the S&P futures, you can get an idea of where price action was when that 345 came. Right, so if I scroll back here, you'll see right off the gate we start running. We have our pullback to the market pulse line. Once we get the pullback to the market pulse line, that's really our entry to try and get a fill into this SPY 345. Then you had to deal with a good amount of heat on this trade. Went all the way back down to really retest the open, and then even a little below that. Didn't quite fill the gap if you were looking at the close, but you still had some heat that you had to deal with on this. So that's where using that call option gives you really just a little bit more confidence in being able to not get shaken out of this trade, since you already know that your max risk is the debit paid, which in my case was $200 per contract. Now, once we saw really this flush move down lower, you then had the S&P rally, giving us that likely trending move that we expected to get, which for those of you that have the futures volatility box, you'll notice that once we did have this fall down lower, that fell really into the previous hour's scalper volatility box lines, which again gives you a better way to try and scale into this position for any remaining contracts that you may be looking at, right? So once we had price action fall here in the subsequent hour, you'll notice that if you extrapolate the previous hour's cyan entry line, we really held that entry line along with the clouds before then starting to bounce from there. So I thought that was fairly interesting. And then really we saw this trending move up higher. I think the total on that call ended up going up to something like 320 or so. And so along the way, you hit different target zones, right, that we would consider to be target zones. Each hour's target line here gives you an opportunity to start to take at least a chunk of that option off for some sort of gains, which gives you an idea of typically once we hit this target line, along with the cyan line, we expect price action to reverse, which we saw happen here multiple times, right? So in the S&P, you hit the target, you then saw a reversal. You hit the target the second time, and this was that grand finale reversal, which led us into really the final few hours of the market open. So that's that cumulative tick trade set up today in the S&P. It doesn't happen all the time, but whenever it does, we like to take advantage of that. Now let's discuss the actual futures volatility box trade. So let me go ahead, remove the cumulative tick indicator here. We can click OK. And so now we have just our volatility box indicator. Now, starting with the volatility box here, we'll start with the S&P, but the process is the same for all four indices. We start by drawing our first hour line test. This is for the four major indices. This is the 7 a.m. mark, and we check to see if we breached either side's volatility box cyan lines. In this case, we had breached towards the very edge of the hour, but we saw that price action was really being respected, and we saw a flush move down in the opposite direction, giving you the confidence that the scalper volatility box was being respected, and you could continue to use that for any scalps for the rest of the day until proven otherwise. Now, looking for the rest of the day, the setup is any breach of this cyan entry line. Once we get a breach of that, we're looking for an edge signal confirmation, which is this green or red arrow, depending on if you're looking at long or short. And once you get that, the trade is a go. The entries at the cyan entry line are placed better than that. The stop is outside of the volatility box, and our target, our first target, is the bare minimum move, so the cyan line minus the outer edge of the clouds. And then the second target is at the other side's gray target line. So now if we keep going forward, the first time we breached that cyan line was in the 9 to 10 a.m. Pacific hour. This is the lunchtime hour for the East Coast folks, where we breached, but we saw really a reaction right off the bat, hitting the first target without getting that edge signal arrow. So this wasn't a trade in which we were able to get a fill, but still gives you confidence that these models are being respected, which again led to the next hour, where in that 10 to 11 a.m. Pacific hour, you'll see that we breached our cyan entry line. This time, we did get an edge signal confirmation, along with an opportunity to enter at the cyan line or better, except we ended up going outside of the clouds where we got hit by our stop here in this wick right here, which you can see, where our stop was 4 points outside from the cyan entry line, and that was exactly this price right here. So that was a little frustrating to see, right? This is getting stopped out to a tick before you see price action go in your direction, hitting not only your first target, but also your second target. And so I don't think there's any better way of saying this other than that was just, I think, unfortunate. It happens sometimes, and I think sticking to the rules here is what keeps you out of trouble more times than not, where this was one of those unfortunate times where you got stopped out really for a wick. Now, to make up for that, however, you had markets like the Nasdaq and the Dow, which gave you some really nice winners along with the Russell. Before we switch to those, though, so once we break outside of the volatility box clouds here, that's then our sign to switch over to the aggressive volatility box, which you'll see the aggressive into the final hour. We really breached the cyan entry line, but only by a wick. Never got the retest of the cyan line after getting the edge signal. Ended up hitting the target right away. And so this was really a touch and go sort of trade where only if you had your orders already parked at the cyan line would you have caught this. Other than that, no chance of catching that. Now, if we switch gears and we go to the Nasdaq futures here, we'll start by loading in the scalper box. I'll go through this one a little bit faster, but this time the trade opportunity came at a very similar moment here. The second trade, that 10 to 11 a.m. Pacific hour, except what should stand out for you in the Nasdaq is this time we breached our cyan entry line, we got the edge signal, and we didn't go outside of the box. In fact, we respected the box. Our first target was 17 Nasdaq points, and we ended up hitting that. Once we hit that first target, our stop is moved from outside of the cloud on the second contract to break even, and then our second target is at the gray target line with the break even stop, looking to see which gets hit first, and we ended up hitting our second target with this wick move down lower, which was a nice gain of positive 50 Nasdaq points. And so that ended up giving us the nicest winner for the day in the Nasdaq. Now keep going forward in the final hour here when really all the markets fell. You saw price action again breach our cyan entry line. We ended up going outside of the volatility box clouds before getting an edge signal, and that was then our sign to switch over from the scalper to the aggressive box. Once we switch over to the aggressive, very similar to the S&P, we breached the cyan line really just by a wick before seeing a pretty sharp reversal here, and so no real opportunity to try and participate in that final hour trade. Now we'll come into the Dow here, repeat the same process, so we'll come back to our scalper models. Starting off with the scalper models here, again, very similar to the S&P this time. In that 9 to 10 a.m. Pacific hour, we breached our cyan line, really respected the clouds, and we saw a pretty nice follow through from that point, right? We went deep inside of the clouds, but still respected the clouds. So still giving you confidence. Then in the 10 to 11 a.m. Pacific hour, again, breached the cyan entry line one more time. This time we get multiple edge signal arrow confirmations along with an opportunity to enter at the sign line or better. And very similar to the Nasdaq, ended up hitting T1 and T2. T1 was 31 points, T2 was 85 points, and that led to a pretty nice flush move down lower for the rest of the day. Again, similar to the Nasdaq, in the final hour, breached the sign entry line. That then went outside of the clouds before seeing our edge signal confirmation, which then takes us to our aggressive volatility box models where we didn't breach the sign line here. So that's the three major indice markets. Now to conclude this video, we'll focus on the Russell. So starting off with the scalper and the Russell looked a little bit different, which I think makes for it to be an interesting market. It was the one that was different from the other three major indices, where our first entry here came in the 8 to 9 a.m. Pacific hour, where you had a breach of the cyan entry line. You then got the edge signal confirmation. However, we never got a retest of the cyan line before ending up and hitting our target in this move down lower. You were looking for 2.3 points and you ended up making that 2.3 points almost right away. So again, gives you the confidence looking for next breaches. Again, you get a breach right here. This time, one more time, you miss the entry before it gets you to the target, waiting for this edge signal confirmation. And so a couple missed entries on the Russell here. And again, an edge of our trade. So this was the story in the Russell where all day long, really, you had breaches that were being respected that also gave you the T1 target. But if you're looking at being conservative and using the edge signal confirmation as your indication of getting in, we never got that fill until that patience was finally rewarded in the final hour where this entry was a little bit more aggressive, but you didn't have to overpay in terms of a great amount, right? It was, I think, by 0.8 ticks or so in terms of overpaying. And so for folks, especially if you're using, say, micro Russell futures, that's really not a whole amount where you can afford to be a bit more aggressive, especially when you see a lot of the other markets also falling, going outside of the clouds versus the Russell, which is still being contained after seeing multiple breaches that have held throughout the day, right? You had one breach, two breach, and third breach, all of which really gave you the reversal that you were looking for. So that was a trade in the Russell. Again, a much more aggressive trade. It didn't quite fit the trade plan for those looking at an entry at the cyan line or better, but that's where you had winners in the Dow and the Nasdaq future, along with the tick trade in the SPY options if you did participate in that. So hopefully this gives you an idea of a few different varieties of trades using both the volatility box along with the cumulative tick and market internals to try and play moves in the four major indices with the volatility that we saw in the markets today. Again, I expect this volatility to continue as we head into election cycle. And so that's where, especially studying these markets, understanding some of these patterns that keep reoccurring, ways to play them can start to become, I think, profitable for the final few weeks leading into the election. All right, take care, everyone. Good luck trading, and we'll see you in the next update.